You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, we've had a couple of weeks off to talk, well, I shouldn't say off. We had a couple of weeks where we were able to talk about investor questions. And it's always great to answer as many as we can. And we always leave our email and want you to participate because you're the reason why we're doing this. And the last couple of weeks, we've been able to answer some great listener questions. This week, we're going to get back into strategies. And I will just kind of mention a couple of weeks ago, we did a trade in Facebook. That was the last time we did a strategy. We actually did a fairly speculative strategy in that we sold a put spread to pay for a long call, an out-of-the-money call, which we don't do that often here on Options Playbook Radio. And the trade turned out fine. There's not really much to talk about because Facebook moved more than the expected move, and that's what we were hoping for. We bought an out-of-the-money call that was around 15 points out of the money, and Facebook opened up and continued on up throughout the day and went more than 15 points. So the call was positive. The short put spread just expired worthless, and the trade worked out on paper. So as always, we just look for scenarios where you have potential for these strategies to work. And that's the way that we kind of teed that one up last week on Facebook. And it's all about learning on Options Playbook Radio. We're not here to make recommendations. We just look for scenarios where this one strategy might be better than that strategy. And time will tell after the market moves. So we still have some earnings around. There's always seems to be a few that trickle in at the end of the earnings season, but I'm going to actually look at a more general strategy that I like to do when the VIX index is trading where it is, around the 13, 14, 15 level. The S&P 500 index today actually made a decent move, so the VIX came off a little bit. So the S&P 500 index actually closed around 1222, and I suppose I should let you know that this is Wednesday, the 16th, and the market did close already, and we saw the S&P 500, it traded right around 2722. It was up about $11 on the day, and we currently have the VIX index trading at 1342, and that was down a point or so today. And in this scenario, it's just really nice to trade indexes when we got some volatility in it. Now, the one beautiful thing about an index, and how I've always teed this up when I've done index webinars, is indexes kind of mute volatility in that you have all these different stocks, and if one goes up, the other one could go down, and that kind of mutes the volatility. So I like to use the kind of oxymoron phrase that indexes will give you some volatility with some predictability. And that, that doesn't usually go hand in hand, but because of the VIX index, the volatility index that tracks the S&P 500 index, is still in the teens, in the 13 to 15 range. When that's the case, you even get a little bit more juice in these indexes. It's not way high. It's not in the 20s. It's not way low. It's not down below 10. So I'm going to take this opportunity to look at a strategy that I like to do when the VIX is trading right around the 13 to 16 handle mark. All right. So with that said, if you have the options playbook on your table and you'd like to follow along at home, please look up for a long spread with calls. That's the strategy that we're going to talk about today. And then we're going to talk about a potential roll, how we might hedge this position if we are wrong. And that strategy would then turn this long call spread into a long butterfly. So it would be combining a long call spread with a short call spread to effectively create a long call butterfly. All right, so that's the whole gamut. That's what we're looking to do today. If you don't have an options playbook, don't worry about it. Just go to optionsplaybook.com, look at strategies tab. You'll see all you need to know right in that section about all three of the strategies that we're going to look at doing today. And I'm going to have to talk fast because we don't have a lot of time here on Options Playbook Radio. And I do want to talk about all the different scenarios here. So one of the biggest things when I'm looking at this long call spread is that I'm going to look to do this trade as where I'm paying a debit, but the net time premium in this strategy is going to be a positive theta, in that as time erodes, it's going to be a good thing for this strategy. So if I look at the S&P 500 index chain, we're going to deal with the 2-day option contracts. As I mentioned, it's Wednesday of this week, and these option contracts are going to expire at the end of the week. It's the 16th. These have an expiration date of the 18th. So we have May 16th on the close. We got all day Thursday, all day Friday for these option contracts to trade. And because of it, I like to steal a term from a friend of mine that looks at butterflies, and he'll call them time bomb butterflies, because we have a lot of time premium still in the S&P 500 index option contracts, but that time premium has to go away because there's only 2 days for the life of these option contracts. And that awards a lot of fun as far as option trading is concerned, because you can still get a lot of time premium and you're only trading 2-day option contracts. All right, so let's tee this up and let's look at the trade, and we'll talk about the time value that's in these option contracts. So the market right now in the S&P 500 index, exactly on the close today on the 16th of May, we see the SPX is at 2,722.46. It's up $11.01 on the day. We're going to look to buy the May 18th expiration. We're going to buy the 27.15 strike call and sell the 27.20 strike call. So both of these options are actually in the money on this vertical spread or long call spread. Even though they're in the money, they both have a lot of time premium, and because of this, we're going to pay a net debit of $3.15 for this trade. So $3.15 is a net debit. That's going to be our max risk on the trade. And the difference between the strikes, which is 5 points, minus that $3.15 is going to be our maximum upside, and that's $1.85. All right. Now, what's good about this trade is that if the market just stays where it's at, we're currently in the money on both option contracts, which is good for this strategy. And if the market just stays where it's at or creeps higher, in 2 days' time, we can make the maximum on this trade. And that's because if we look at just the extrinsic value or just the time value, on the one that we're buying using the midpoint, we're buying about $6.35 worth of time value, and we're selling $8.20 worth of time value. And because we're selling more than we're buying, that awards us this benefit that if the market just stays where it's at, this will become a profitable trade and will actually reach the max profit. We just need it to stay above 27.20. All right. Now, we put this trade on tonight, market opens tomorrow, and the market continues on up. Well, that's a great thing, right? We get a 5 or 10 point move to the upside. Heck, you can just close this trade out, and maybe just because of the time value erosion, which is going to be huge on Thursday, it's going to be a very large rate of decay because these are still very expensive option contracts. Just because of time decay alone, you might be able to close this out for a 50 or 60 cent profit with just a small move to the upside. Now, in my situation here, I'm going to try to risk about $1. I'm going to try to make $1 on the upside, which means I'm selling it for $4.15, and I'm willing to lose $1 on the downside, which means I'm going to get out at $2.15. If I were to just do this trade outright and I was not willing to adjust, that's where I would come in and actually, that's the trade that I would perform, and those would be my risk parameters. Now, on the upside, everybody knows what to do. It's a winning trade. Eventually you sell and you get out. Now, on the downside, if the market comes down, though, one thing that I always like to look at is potentially selling a short call spread and not just bailing from the trade. So tomorrow you have one day to make this decision if you want to do it. If it's on Friday, it's going to be too late. So you want to look at this trade tomorrow and think, this is my tradable day. The thing is that you have a huge rate of decay on Thursday, and then Friday, there's just not as much time premium left in it. So if you're going to adjust the trade, you're going to want to do it on Thursday the 17th. Okay. So if I look at this trade right now, the adjustment would be we're going to sell the 27.20s and buy the 27.25s. If we did that trade, we could bring that in a net credit of $2.80, which means effectively, if we did the good old-fashioned butterfly where we bought the 27.15, sold 2 of the 27.20s, and bought 1 of the 27.25s, we would be looking at doing the entire trade for about 35 cents net debit. But we're going to wait. We're going to hope that we're correct on our forecast. We're going to hope that the market comes up. We know that this is trading for $2.80. We know that we paid $3.15 for the long spread for the trade that we were looking at. So I say to myself, if this comes down $1, and right now that credit spread is $2.80. If I see that trading for $1.80, between $1.80, $1.50, I'm actually going to put the trade on. I'm going to wait for it to come down. I'm going to wait for it to go against me. And if it moves against me $1, all right, well, if I sell it, let's actually kind of make it a nice round number. So $3.15 minus $1.80 would be $1.35, right? So if the market came down and I was able to sell this credit spread for $1.85 because the market moved against me, that means that my total risk on the trade would be $1.35. But I still have on a butterfly, a 5-point wide butterfly. Now, granted, 5-point wide means the total butterfly is only 10 points overall, and it's hard for the S&P 500 index to land within a 10-point range on that end of the trading day on Friday, but it gives me an out. So in other words, I am going to lose on this trade. If I get this trade off for $1.85, that net credit, I am going to bring in my total cost of the trade is going to be $1.35, right? So if we paid $3.15 to start, we wait, the market starts going against us, moves about 10 points to the opposite side. I can now sell the credit spread for $1.80. When I do that, we have $1.35 of total risk into the butterfly, and that's all that I can lose on the trade. I'm looking to make about $1 on the upside. If I don't make it, I'm going to manage my risk by selling this credit spread, and then I'm just going to let it ride. And I'm going to see where I end up. If on expiration or we're getting close to the end of the day, I can close it out and maybe make another 50, another 75 cents, then I just get out of the trade. I'm just looking to try to get, I don't want the cheese anymore. I just want out of the trap is really what my goal here is on this trade. But I still have potential in that I'm in this long butterfly that's centered around the 27.20 strike. And if the market moves down 10, I roll into the credit spread, which also makes me a long butterfly. And then if the market happens to bounce back, well, guess what? I can benefit from that move. As long as that market stays somewhere between 27.15 and 27.25, well, I get whatever cash is available or awarded to me at the expiration of the S&P 500 index options on the 18th of May. All right, so let's recap. So if I'm looking to do this trade, and there's a lot of numbers here, the simplest way to do the trade is when we have the VIX trading in the teens, means that we're going to get a little bit more premium out of the S&P 500 index options that have just a few days remaining. So with the market at 27.22.46, we're going to go out and buy the 27.15 call with 2 days remaining to expiration, and then sell the 27.20 call, same expiration. We're going to do that entire trade for a net debit of $3.15. If the market continues on up, well, that's fine. We've got a positive trade. If it comes down, and I'm talking maybe 10 or 15 points, let's say on Thursday, the market starts moving down, my hedge is going to be to go out and sell the 27.20 call, another one, an additional one, and buy the 27.25 call. We're hoping that we can get at least $1.80 for that trade. If we get $1.70 or $1.60, that's fine. But in that range, we're going to use that credit to reduce our overall risk of our long spread, and then we're just going to let that trade ride and see if the market can come back to our short strike. And if it does, that's great. If not, we've already limited our risk on the trade, and we're just going to go on and wait for our next trade next week. All right, that's it for this episode of Options Playbook Radio. If you have a topic you'd like to discuss on the show or a question you'd like us to answer on the program, send them directly to me at theoptionsguy@invest.ally.com. theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.